What's going on, everyone? My name is D. Anthony with Evolution Traders. I'm a full-time options as well as futures prop firm trader and educator at evolutiontraders.com, helping traders become more consistent, become more profitable, and help get a better understanding of how to navigate the markets. In this video, I want to explain to you guys, because I think these terms, right, this terminology gets confused, and a lot of times newer traders or traders who are still trying to find their way have difficulties understanding risk versus position size. Also, stop losses, right? So these three things are all terms that you've heard before. Manage your risk, position size, make sure you have a stop loss. All three of those things you've heard hundreds of times if you've been watching YouTube videos, you've been watching other content creators or other educators, mentors, coaches kind of explain these things to you. But what doesn't get talked about a lot and what doesn't get emphasized a lot, because a lot of times, depending on your strategy, depending on how you trade, what your edge is, right? What your process, what your strategy is, can differ the way that you manage risk. So managing risk is all about managing your available capital. It's all about having that drawdown be managed in a manner to where you can still take trades and not get blown out on any one particular trade. Now, here's where things tend to get a little sticky, because a lot of times you'll ask traders, are you managing risk? Do you have stop losses? And they'll say, yeah, well, I trade 5 contracts and I always put a stop loss, right? My stop loss is 25 points on the NASDAQ. My stop loss is 12 points. It's 15 points, whatever the case may be, right? Sometimes my stop loss may be different, right? It's dynamic. That's great. In having a stop loss, if it's not a hard stop loss, it's a hard mental stop loss. Having a stop loss is definitely going to protect you, and it's definitely going to save you from getting blown up, right? From blowing an account. Great. But what you don't understand is that position size, aka your stop loss, is different than your risk, okay? So a stop loss just means that if price touches this area or it breaches this area, I'm going to get out of the trade to protect me, okay? But your risk is what's more important. Your stop loss is fine. Someone can have, and I'm going to use the NASDAQ as an example, someone can have a 75-point stop loss on the NASDAQ. Now you may be thinking to yourself, who in their right mind would put a 75-point stop loss on the NASDAQ? Well, maybe if someone's looking for, a 2R trade, a 3R trade, maybe they want to give this trade enough room to wiggle. And they need to ride the waves of the up and down movements because they're looking for more, right? If your position size is out of whack, your risk is going to be totally in shambles. So just having a stop loss doesn't necessarily mean anything. For example, if I ask you as a trader, what's your position size? How many contracts do you trade of the NASDAQ? And you tell me, I trade 5 micro contracts. Great. Well, 5 micro contracts with a stop loss of 30 points is going to be a much bigger risk than someone who's trading 1 contract with a stop loss of 30 points. So having a stop loss is not managing risk. Having a stop loss is simply telling you technically you are wrong on the trade and you need to exit. And if you don't exit here, potentially you can be in a lot more danger. Okay. So the real way that you manage risk is by your position size. Doesn't matter if I have a 100-point stop loss or a 10-point stop loss. The only true way that I can manage risk is by the number of contracts, aka my position size that I'm playing. So for me, I use a dynamic stop loss, meaning every single trade is going to have a different risk to reward ratio depending on the volatility, the price action, and where I potentially see the price going. Now, there's no right or wrong way to trade, and there's no right or wrong way to take profits, but I am a one-to-one trader. My strategy hits over 50%. Sometimes it's 50, sometimes it's 65, sometimes it's 75. I'll have days where the market is running or the market is being cooperative, right? Because not every day the market is cooperating with us, but I'll have days sometimes where maybe I take 4 trades and I only lose 1, or I don't lose any at all. And I'm hitting at an 80% hit rate. Now, that's not to say that my strategy is better than anyone else's. That's just the name of the game. And sometimes the market provides those fantastic opportunities. But because my stop loss is dynamic, I can't play the same number of contracts on every trade, because then I wouldn't be managing my risk properly. I'll give you an example. Let's say I have a trade setup that has a 12-point stop loss and I play 5 contracts. And that trade works out in my favor, and I take 12 points return on that trade. Great. Okay. So I'm going to be making about $25 a contract, and I'm playing 5 contracts. I'm going to make somewhere around $120, $130, depending on when I get out in commissions and fees. Now, let's say the next trade that I take is a 25-point stop loss, and I still play 5 contracts, because when someone asks you, how much do you play? What's your position size? Well, I always trade 4 contracts. I always trade 5 contracts. Great. But what about if your stop loss is a little bit bigger on the next trade because it needs more room to work, or it's a bigger candle, or we're looking for more of a return? And let's say that second trade that I take is a losing trade. So now I'm not losing 25 points or $25 a contract, I'm losing $50 a contract. So if I lose $50 a contract and I'm trading 5 contracts, I'm going to be losing upwards of $250. And now not only am I negative on the day, but I'm down pretty bad. If I made $120 on the first trade and I just lost $250 on the second trade. Well, some people may be thinking, how can you lose if you have a stop loss and it should be protecting your risk? Well, that's where the difference between just having a stop loss and understanding your risk based on position size is 2 different things. So you need to make sure, depending on whatever setup that you're getting in the market, you are protecting your risk based on the number of contracts that you're playing, not just because you have a stop loss. Here's something else that I want to add. Sometimes people have a generic stop loss and a generic take profit. I don't like this way of trading. This means that someone has a 15-point stop loss and a 30-point or 40-point take profit. So psychologically, they're telling themselves, okay, I'm risking 15 points, but I'm going to make 40 points on my return. Now, your stats are going to be a lot lower because the probabilities of it hitting 40 points before it drops down 15 is less. So you might have maybe a 30 or 40% win rate, which can be profitable if tested over a series of trades. At least 100 trades, you need to see, is it actually profitable? But let's say that it is. You can't just simply put those generic take profits and generic stop losses based on some fictitious number that you made up in your head. Well, I want to risk X amount of dollars because I want to make X amount of dollars. So here's my setup. Let me just put this random bracket order on here, because what if that generic stop loss is, let's say 15 points or 20 points. Let's say it's right in the middle of a previous structure. So maybe let's say at 29 points, there's some structure here where if we were to lose that previous structure zone, there's potential for downside, but you have a stop loss at 15 or 20 points. What are the odds that you're probably going to get stopped out there, and then the price is not really going to even hit the stop loss previous structure, the low, and then go the other way in your favor, which would have resulted in a winning trade for you. But because you're fixated on, well, I want to trade 4 contracts and I want to only risk $15 or 15 points to make 30 points or 40 points or 60 points or whatever. That's why I don't really like those generic stop losses and take profits. You always want to make sure that your stop loss is in line with something technical on the chart, whether it's a moving average, whether it's a previous candle, whether it's a previous swing low or swing high, or a previous demand zone or supply zone. You always want to base your stop loss around an area where there's technical damage, meaning on the chart, technically, there's no reason for you to be in that trade on that particular bias. I hope that makes sense. So when you're managing your risk, make sure that you're not just managing your risk by having a stop loss, but by managing your position size based on that stop loss. That's how you manage your true risk. So for example, those of you guys who trade on the prop firm side, let's say, for example, you have a $50,000 account and you have a $2,000 drawdown limit before you lose that account. Well, if I set up some rules for myself where I don't want to lose no more than $200 a day, either I can do one of two things. I can take one trade and position myself with the number of contracts where if I lose that one trade, I'm only going to lose $200. Or I can say I'm only going to lose $75 a trade, but I'm going to be able to take 2 or 3 trades on the day, because if I lose 3 trades, I'm going to be around $200 loss. I'm going to stop trading on the day. That's how you manage your risk, and you manage that risk by skewing the number of contracts that you're playing. So if, let's say, for example, one of the trades that you're going to take is a 25-point stop loss, and you play one contract, micro, you're going to lose $50. If you're comfortable losing $50 on this particular trade, understand that at a 1-to-1, you're going to win $50, and a 2-to-1, you're going to win $100. Just do your math from there and where you're going to take profits based on your process and strategy and edge. But I'll just use myself as an example. I use a 1-to-1. So if I'm going to risk $50, I'm looking to make $50 on my previous trade, right? So I might play 1 contract or 2 contracts or whatever. So if I lose on 2, I'm going to lose $100. But let's say, for example, I want to take more trades in the day, or I want to take less trades in the day, but I want to make more money. Then maybe on that 25-point stop loss, maybe I play 3 contracts at a $50 loss a piece, meaning I'm going to make or lose $160 or $150. So in that particular scenario, if I was to take one trade and win, I'm winning 150, and if I'm losing 150. Does that make sense? So if I have a rule put in place for me that I don't want to lose any more than $200 today, then with that risk management strategy, you're only going to be able to take one losing trade, and then you have to shut it down because the next one is going to put you well over $200. So if you're a type of trader that wants to take 2 trades or 3 trades or even 4 trades a day, you have to manage that risk with the number of contracts that you're playing, because if you were to lose 1 trade or 2 trades or 3 trades or 4 trades, would that fall under that $200 daily loss limit that you set for yourself? Or it could be $100 or $500 or $300, whatever you set for yourself. So manage your risk with the number of contracts that you're playing, which is position size. Do not think that you're managing risk by having a stop loss, and get away from the generic stop losses of I'm going to only risk 15 points or I'm going to only risk 20 points. Make sure your stop losses are set up around technical levels, and if they're damaged, you can take the trade off the table. I hope this makes sense. If it does, like, comment, and subscribe, and I guarantee you're going to make more money, you're going to be less stressed, and resulting in you being more confident and consistent in your trading if you start managing your risk the right way.